Good morning. Mark Madden, financial planner and wealth coach for Draca Group. It's another beautiful morning here. It's about 7:30 a.m. on the Tuesday following the long weekend. We've had some great feedback on the goal and objective setting videos we've done, so I thought we'd just take a bit of time out and give you one of the basic concepts and principles behind investment making decisions. So feel free to use these 5 points, and I'd love to hear any feedback you've got in the comments below. So the first one we're going to look at is goal and objective setting. As a wise man once said, before beginning a hunt, it's wise to ask someone what you're looking for before you begin looking for it. That wise man was Winnie the Pooh. So when it comes to investment decisions, we've also got to first look at what are we actually trying to achieve. So jump ahead and say, where do I want to be in 5, 10, 15 or 20 years time, and start to reverse engineer those steps to get there. For more information on goal and objective setting, see our previous video. The next one is diversification. So when we're looking at diversification, all eggs in one basket is not a sound investment strategy. So make sure you've got a reasonable spread where possible between shares, property, cash, fixed interest, bonds. Shares again can be split between domestic and international, so forth and so on. But hopefully what will happen is if a couple of sectors don't stay up, then the remaining asset classes will help keep you buoyant. One of the next ones to look at is one of the most powerful ones in our financial planning toolkit, which is compound interest. So simply put, this is interest applied upon interest. So if you place an investment over a 12-month period and you earn interest, if you reinvest it the following year, you actually earn interest on the principal sum plus the interest just earned. So make sure where possible you're applying dividend reinvestment plans or reinvesting income to take advantage of compound interest. And we're lucky in Australia to have superannuation as well, which is effectively a forced retirement savings plan, which has compound interest applied because we got restricted access. The next one is time in market versus timing the market. Studies have consistently shown that if we stay in long enough, markets will recover and continue to perform. Trying to time the market comes with a whole series of risks of effectively getting it wrong. And the last one is going to be the fear of missing out or following the herd. Generally, herd mentality or pack mentality means that investments will spike relatively hard and above fair value, and in exchange, it'll do the opposite when it comes down. So just be mindful of this. If you've got any questions, feel free to comment below or check out our website on www.dracagroup.com.au. Take care.